Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to talk about higher interest rates and what it means for you as a consumer if you're going out there to purchase a new home or refinance your existing home and mortgage, or what it means if your mortgage is coming up for renewal as interest rates are on the rise. Stay tuned, we're going to dive right in next. If you're watching this video on the Team Sessa Real Estate YouTube channel, thank you again for tuning in. Wow, all I have to say is thank you for all the comments and the support that we're getting from all our viewers on the Team Sessa Real Estate page. We really appreciate everyone's time and you taking the time out of your day. So don't forget, please hit the share, like, and subscribe button, as well as the notification bell while you're down there to help you get notified every time we post a new video, as well as if you're down there and you want to book a free consultation to talk about your mortgage or real estate needs, feel free to click on the description box under the calendar link and book a free consultation with myself or Santo. And now back to the video. I want to start off this conversation with an actual scenario and why we're actually talking about higher interest rates right now and some of the things that you should be paying attention to if you're going out there to purchase a home or refinance your existing one. One thing I do want to have a discussion about first and foremost is, yes, obviously there's a lot of Canadians who maybe had a mortgage back in 2017 or 2018 who might be approaching their renewal window, and you should be anticipating at the current time right now much higher interest rates than previously what you locked in for, and budgeting according to what the new payments are, having a discussion with your lender or your mortgage broker about where rates are headed and if you can renew early or maybe securitize a new rate with your lender ahead of time. Now, when we look at the case that we're going to be discussing here, I had a client that called us, and what happened was they had sold their home. They had a pre-approval in place with an existing lender, but when they went to go through the actual documentation, they had noticed that there was some discrepancies or something that happened over the last few years that caused them to not be able to get, or for the bank that they were with to honor their existing pre-approval. And they had reached out to us to see if we can help assist them to get them a very good aggressive rate, but also more importantly is to get them approved for when they go out there to buy, as they were sort of hesitant and they were approaching the timeline where their home was sold, and they're going to need bridge financing in order to get them through to the next purchase. At the end of the day, these are scenarios that actually happen out there. So having someone who knows what they're doing, I guess, speaks for itself. I don't need to sit here and explain to you why, it's important to have an opinion or second opinion when it comes to your finances, especially as interest rates are on the rise. So speaking about our client, they had basically sold their home, and, they had sold their condo. They had a very limited amount of money that they can put down in order to get them into the next property. They were looking at a purchase price of $1.2 million, and they had about $50,000 to play with as a down payment in order to get them through the door. They did have some children, so the place that they were at right now did not meet their current requirements. So they have no choice. They needed to jump up to the next level up. They were looking at buying a townhouse. And yes, obviously the prices have fluctuated as the markets have shifted a little bit. As we're watching videos, we're starting to see, and listening to the data and hearing the economists, as we're starting to see a little bit of a softening in the market. If it's temporary, we don't know, but the client basically is in a position right now where in a few short weeks, they're going to be homeless unless they go out there and buy something. And now might be an opportunity for them to get the house that was maybe priced a little bit higher a few months ago, just a little bit under, or not have to compete with multiple offers, as they were able to put in an offer. So because of what had happened, they had securitized on their pre-approval a few months back in order to meet this window. They were given a very aggressive rate. So obviously the client understood that that rate is no longer on the table, much like what I talked about last week with my existing client. And so what happened now is we had to go into a different lender that was going to approve their particular scenario. Remember, I had mentioned that they had some scenarios, and this was a top 6 bank. So we had to move it to another top 6 bank who was, willing to look at this deal, and we were able to get them approved. Obviously, the rate was around 4.09%, much more expensive than what they had previously, looked at. And however, that actual change in interest rate what it had done was push them out of qualification as well. What I want to do right now is just go into a little bit more of the scenario and why this video is sort of important if you're going out there to purchase or you're going out there to refinance or restructure your mortgage as rates have changed. Looking at this example, what I want to do is stress my scenario and why we're doing this video. So the client, as I mentioned, was limited in the sale of their condo. They were basically left with around $250,000 and change dollars to come down with. Obviously, there was closing costs, land transfer tax, which they had some assistance with. So basically, the rate that we were quoted was 4.09%. Now, what's important to understand is, yes, their payment would have been $4,614. Now, when you're looking at the 4.09%, you have to add 2% on that posted rate. That's the actual, discount rate that they were given, plus 2% brings them to 6.09%. That's what they have to qualify under, not the 5.25, because the current rate is 4.09 plus 2 is 6.09. So if I draw your attention down to the bottom lines here where it says income required, but they were well over the amount that was required for them to service this mortgage amount. So they were definitely okay to cover it. What happened was the numbers were skewed a little bit when we started to plug in the 2% increase to 6.09 up from 5.25%. So that income required for them was, for example, $193,000. So basically you're seeing here their income was $177,000 as opposed to $193,000. Now, obviously we worked with the lender to get a couple of exceptions to try to get them through the door. But by qualifying them at 5.25%, which equated to using the variable rate product as opposed to the 6.09. So I hope that's clear. So as you can see from the charts and the feature sheet that we had discussed with this client, how qualification had impact them is no different than someone going out there to purchase a new home or refinancing their existing home, depending on the rate that they select. As we start to see interest rates creep up over the 4% mark with many of the major institutions, one thing I do want to draw your attention back to is, obviously, if it's an insured mortgage or a conventional mortgage, if it's a 25-year amortization or 30-year amortization, in this particular scenario, we were required to go with a conventional 30-year amortization to help bring the ratios back into line so that the client can qualify. So these are important things to understand for many clients moving forward. And I know there's a lot of sentiment out there like, oh, I have a mortgage, I don't need to worry about it, I'm fixed, I'm a small mortgage amount. But yes, if you're going out there to make this move, obviously there's a couple of things that we have to bring back into focus. Is your pre-approval valid? Like for this particular client, they thought they were good to go on their approval that they had done at their bank, and then come back to us with the scenario where it wasn't valid. And because most pre-approvals, unfortunately, are only underwritten at the time of a live deal. It depends on your institution. So that's important to understand. Obviously, locking in that rate for 120 days, very important, something we talked about last week. And for this particular client, obviously understanding what their payment is. Speaking of the client's payment, I want to bring in this example. Here we have basically what we do is a active summary for our clients. We do like a presentation for the rate, their payment, so they can understand exactly what their payment is, how much money that money is going towards principal, how much of it's going towards interest, what the actual graphs look like as they're paying down their mortgage, but more importantly, what their amortization summary looks like. Because this is basically a good indication when you look at how much money is going towards principal and then towards interest. And one thing that's important to understand here is that the client's payment was $36.45 on the 2.2% variable, as opposed to the 4.09% fixed, where their payment was actually $4,614. Is a $1,000 difference between the client's payment. Now, when you're looking at that payment discrepancy and saying, wow, it's almost $1,000 or just shy of $1,000 difference per month, it's obviously for many Canadians a sell feature. And that's what we were talking about last week, is how much of the new mortgage origination is actually taking place on the variable end because of that runway. So when you're looking at the prime lending rate, which is at the time of filming this video, still 2.70%, and then minus the discount that you're being offered, let's say, whatever that amount is, in this particular case, it's literally 50 basis points. The client's at 2.2%. At 4.09%, that's literally almost, almost 2% difference, or almost a 2% discrepancy. And when you're looking at where the rates are on the current table and saying if interest rates go up and if interest rates stay the same, if the Bank of Canada increases 0.5% or they don't increase 0.5%, how many increases are built into the 2.2 as opposed to the 4.09%? And then looking at those options and saying, look, here's the $1,000 difference. And in this particular case, because as I mentioned, it's not that we forced or pushed the client into the variable rate product, our hands were tied in order to get them approved for the amount that they required in order to get into the home and the market and the community that they wanted to stay in for their kids. So this is something that we looked at and said, look, you have $1,000 on the table. You have an option. You were comfortable at the 4.09% payment if you had to take that on. And that $1,000 difference, you can do a few things with it because the lender that we placed the client with allowed them to increase their payments anywhere from 15 to 20%. And that means that they can actually put some of that money that they were willing to lock in on the fixed component into the variable payment and basically hedge their bets going forward, because any payment that you make above and beyond the amount that you're required to pay goes straight towards principal and bypasses interest. And when we looked at the client's amortization summary, much like any amortization summary that you're going to receive, whether you're refinancing or purchasing a new home, that the lower the interest rate stays for longer, more money will go towards principal, as opposed to the higher the interest rate is, the more money will go towards interest than towards principal. So you have to always take these into consideration in a higher rate environment. And I want to know your thoughts. I mean, these are my thoughts and my opinions. As a mortgage holder myself, I've always been in a variable rate product because it's something that I believe in. But once again, we can't tell our clients what to choose. It all depends on what they feel and what their appetite to risk is. So I know in the comments that we see a lot of people saying, oh, they should have gone fixed. Fixed is wrong. Variable's wrong. It all depends on the client scenario. In this particular scenario, the client didn't have a choice, right? In order for them to qualify and get the home that they wanted, obviously there's going to be some people that don't agree with that and will maybe think that they should have gone a different route. But I understand that. I want to know what you think. We always want to hear other people's opinions because that can help us not only as a brokerage, but also clients out there that are reading these comments. And basically, maybe they're out there in the process and they're looking to see what other people are saying. So it's important to have this conversation. Actually, I want to throw out this question and I want to hear your thoughts below. Is now maybe a good opportunity for buyers to get into the market? Is this the opportunity or the window, shall we say, for buyers to get in? Or is the market going to further slow down and more inventory going to drive prices down or drive them up? That is something that we would like to hear your feedback on as we move forward in our Finance Fridays journey and understanding and how it can help other people make those decisions. Please let us know what your thoughts are. Leave those comments below. Don't forget to hit the share, like, and subscribe button, notification bell. Make sure you get notified every time we post a new video. And we'll leave it there. I hope everyone enjoyed Finance Fridays. It's Friday. We wish everyone a great weekend ahead. Until next week, we'll see you next time.